All right, guys, so this video is going to be about risk management. I know risk management is a huge turnoff to a lot of you guys. It's a big topic where like people try to avoid. So if you're watching this video, risk management is the mother lode of why 99% of traders fail. Simply because they don't know how to manage or accept risk. Really, 99% of traders fail, and this is crazy because it is because of the simplest thing, risk management. You can have risk, just manage your risk and accept the risk. Very big difference between both of them. So common issue traders, beginning traders, seasoned traders, any type of trader they come across is that they're too optimistic. What I mean by that is that they take a trade thinking, how can it go against me? Like looks like a beautiful buy, like a beautiful sell, it's selling, it's rejecting off a resistance. How can it go against me? And this is a big mistake because we are already automatically entering this knowing that what's going to happen in the market, which is basically impossible. So what we need to do is prepare for the worst, but expect the best. So I'm going to give you guys right now, I'm going to simplify the risk management tools and rules that I use every single day. It has become second nature to me, same way how it's second nature to brush your teeth in the mornings or put on your clothes or whatever the case is. Without this, I can't take a trade. Without brushing my teeth, I can't leave my house. It is second nature. So these are very simple, straight to the point, and you will see if you implement it over a course of time, the difference in your P&L curve. So based off of my experience with the markets, I know exactly what months to up my percentage and I know what months to down my percentage. It is very simple because I have that experience and I know what months tend to be best for me. So for my example, this is what I do. The first 3 months have always been the best months for me, along with the last 3 months of the year. So I know Q1 and Q4, I can up my risk 1.5, 2%, never more than that. So for the whole month of January, I risk 2%. The whole month of February, I risk 2%. The whole month of March, I risk 2%. Same thing goes for all of October, November, and December. So now what happens with all of these months within the middle? Well, you need to calculate which months are you tend to be worse. For me, I always tend to do trash, or not trash, but my performance isn't always the best in May. So you best believe I'm not going to come into May risking 2%. I'm going to simply bump down my risk to 1% for the whole month of May, because now I know that May is not my month. So I'm going to go in with a different attitude, with a different, I'm going to walk in, chill, not walk in as aggressive as I did with these months, just because these months, there's something about my trading style. I don't know if it's pure coincidence or whatever the case is, but these months for me are not the best. So I know April is all right. May is never the best. June's okay. July's okay. August never has been great. And then neither has September. So I know these other months, I tend to be a little away from the charts, not that on them. I look at them not that much compared to the other months where I come in more aggressive. So now you know what months you're good at trading. So you're only going to risk that certain percentage, the full 31 days, the full 30 days, same 30 days. And that is it. You're not going to, 2 weeks in, you're doing good, you're gonna up your risk, because as soon as you up your risk, then you enter a losing streak, and then it just messes up the whole P&L curve. My rule number 2 is my stop loss at a place of no return. What do I mean by that? I know this is really like a great technical course. This is strictly psychology. When I do create my technical course, if I do, I'm gonna go into great detail in this. So if you guys do want to see more of that, let me know. So what do I mean by placing your stop loss at a point of no return? So let's say right here, we are clearly in a level of support. You can clearly tell this is a very strong level of support. We're on the daily time frame. We have 1, 2, 3, 4, 5 strong daily rejections. I'm sure if we drag it left, it's resistance, and so on. So now we know that every single time price comes to this level, it is going to reject. So if we're looking to buy at this level, our stop loss needs to be under this support level. Why? Because if we break under this level, then what are we going to do? We're going to then use it as resistance and then head to the downside. So that's what I mean by the point of no return. We are buying at the point of no return, that if it hits our stop loss and it goes against us, we were 100% wrong on the buy, and then we react and adapt to what the market shows us, and then now we look for sales and no longer buys. So this is a perfect example of how to place your stop loss at the point of no return. You can see how here it clearly rejected that point of no return. It's either going to buy from here, continue rejecting the strong support, or we break, retest, and then we completely change our bias now to sells. Rule number 3 is my risk to reward a minimum of a 1 to 2. So for example, this trade right here would have not been a trade I would have taken. And you guys would be like, why? It's only 0.2%. Well, no, my rule says minimum 1 to 2. If it doesn't say this, I don't want it, because it messes up the P&L curve on the long-term wise, because then whenever you win, the wins aren't bigger than your losses, and then you won't end up being profitable. So the trades need to be a minimum of 1 to 2. And I do not touch my trade until it not hits the 1 to 2. Yes, I will hold to the 3, 4, 5, 6, whatever the case is, but it needs to hit my 1 to 2. The trade needs to be set to have my first take profit at a 1 to 2, and that is it. There's no other way around it. What about a 1.9, 1.5? No, 1 to 2 is your target. That is it. Rule number 4, where are my targets? Are my targets at a level that if it breaks, I can continue going to the upside? Or are my targets a point where it taps and it could come back and take me out at break even or be a loss, whatever the case is? So for this example, we literally look left, so where my target would have been at a 1 to 2, and you can clearly see that it is a level of strong resistance, support, resistance, and now we are pulling up to this level. So the only way that I would be interested in now holding this trade is because it breaks that level. But I am targeting here. Why? Because it is a level of resistance. So the only way I can hold and continue trailing my stops is if it breaks above this level. So let's see what happens. So now we know that we have broken above this level. So now we're at a point where do we target the next point? Well, the next point we target is simply the next structure level. Clearly you can see it is a potential point where price can stop, which is resistance, and so on. So this is how you trail your stops and then move it to the next structure point. But this is something very much more technical that I would have to go into depth, and I'll do that in the other course if I end up creating it. But it is something very extensive, but it is very simple once you get the hang of it. But you need to understand where it is you're getting out. Why? Because it's a level of resistance, or why? Because it's a level of support if you're selling. These are my second nature rules. I do not think twice before I enter a trade. This is what it is. It is that simple. There is no need to complicate it. There is no other equation. This is just what it is. And I have been doing this for the past 3.5 years, 4 years. And the thing is that I have never broken them. Yes, obviously I have broken them here and there. Maybe I've had trades before that have been at 1.9, or I have closed out a little bit early because of news or whatever the case is. But this is my strategy when it comes to risk management and psychology. It is that simple. There is no need to complicate it. So the most important thing about those rules is that they keep you in the game. Whatever you have invested, let's say it's $1,000, $10,000, $50,000, whatever it is, they are safe. You're not out there exposing all of your hard work earned money simply because you are not aware of what it is that you're risking, because here you have a controlled risk of whatever it is that you are trading on. And then what this does is that it keeps your mind in check, it keeps your psychology in check, so now you can truly master your craft and then your whole trading style. It is because if you don't know what months you do good and you don't know what months you do bad, then you tend to be in this whole up and down, and then you never figure it out because you're not structured. So having those months, accept the risk within those months, now you are structured, and then now you know when to be a little more aggressive and when to be a little more conservative, because you now have planned ahead for what the markets can be in these months. And if you don't have that data, you don't know what months you're good, it's all right. This is a marathon. This is not a sprint. You will collect that data. You just need to write every single thing down. And this is something very key, because if you really like, how are you going to master this if you keep blowing accounts? It just makes no sense. So this is going to avoid all of that. It is that simple. So these are the rules that I live by on my private, funded, personal, investor, every single type of account. It does not matter. It's like you're not going to change the brakes on your car just because you're going to go drive on a different road. It's the same brakes, same car. It's just you drive different on different trails. On the regular street, you're going to drive normal. You're driving through a dirt trail, you drive more slow, but it's the same brakes holding you from whenever you're going to hit. It's the same risk management, whether you're on a big account, small account, medium account, it doesn't matter. You're still accepting the risk and you're in full control of what is to be exposed of the account. And this literally keeps you in the game long. Like it literally, if you're risking 1%, you need to lose 100 trades in a row. Put that into perspective. First of all, for you to take 100 trades in a row, it'll probably take you more than a week, because it's very hard to find any high probability setup that frequently within the market. So risk management is the mother lode to success when it comes to trading. The other very essential rule is a stop loss. You need to place a stop loss. Without a stop loss, you can't calculate your risk. You can't stop the account from being in drawdown. How are you going to calculate 1% if you don't have a stop loss? You can't just throw a 5 lot, 10 lot, 50. No, there's no way, because you don't know how many pips you have calculated from your stop loss. My best analogy when it comes to a stop loss, it is this simple. You can drive a car without brakes. Yes, you can get lucky. You can run a stop sign here. You can run a red light there. But eventually you're going to have to stop. You're going to run across that yellow light, and then you're not going to have a chance to get across, and you're gonna have to stop. If not, you're gonna hit the car crossing. It's the same thing when it comes to trading. You can trade without risk management, and you can trade without a stop loss, but you're gonna end up where you run into that stop sign that you couldn't have taken, and then boom, you crash your car, and then you crash your account. So now that you have your risk management in check, you have your stop loss, you're not emotional, you're not greedy, you're not fearful to take a trade, your emotions are all in the right place, everything is in check. Now literally comes the easy part, and that is take the trade. Your strategy. What is your strategy? Well, we all have different types, but now comes the easy part, because now you literally have a checklist of what you look for in the market to take the trade. If you're looking to buy at support, well, now you simply just wait for price to get to your support level and then you buy it. That is it. You have a strict plan of technical analysis to then take your trade. Now what you need to do is just find your edge on what works, and that is it. Implement it and you will see the results, because you're trading according to your plan that you have technicals. My trading style is very simple. It is simply all time frames need to be in sync for me to buy or sell. I'm not going to take a counter trend trade for a retracement because I don't control the markets. I can't predict that retracement to where that I'm looking to sell. So my trading strategy, it is very simple, but to understand it and then get all of that patience, it does require extensive explanation in length. I do cover that in the Learn and Earn in my YouTube videos. Literally go check all that out. If you guys think I should come out with a trading course because you guys saw this course and you guys thought you guys benefited from it, or you guys helped, let me know. Send me a DM, send me through the Telegram, whatever the case. Oh, I did the psychology course. I think trading course would be great, because again, I didn't see any psychology courses out there, and I feel like that's what you guys would benefit the most from. And I don't really see any swing trading course out there, so I don't think there's nobody out there that trades like me, or at least I believe. Again, correct me if I'm wrong, but I do think again that you guys will benefit from it. So if you guys requested that much, then I'll put another 6-7 months into it, so you guys get a very, very good product and you guys can benefit from it. So moving on. So what we need to know and understand is that the most of doing in the market is literally doing nothing. And this can be a very big issue, because most of us, like myself, we come from a place where we're usually working 9 to 5 or 7 to 4, whatever the case is, and we're used to be on go mode 24/7, meaning that the more we do, the more we get paid. Well, that is so wrong when it comes to these markets, because you come with that same energy into here, and then you're like, I've been sitting in front of the charts for 5 hours, I need to get my money because I have put my time in, I need to get rewarded the amount of dollars. That's not the case. The markets don't give a shit that you've been in front of the charts for 5-10 hours. The markets don't give a shit that you've deposited your whole bank account. They have no idea. They're not aware, because this causes like an internal conflict with us, because we're like, wow, I almost feel useless, like I haven't really been doing nothing for 2-3 days. There hasn't been any trades for 2-3 days, and then I am not getting any money. Or maybe you have been putting all this work in for 2-3 days, and all you've been doing is straight losing. So now you feel some type of way, and then that's where your emotions start going in circles, because now you are not used to this type of situation, because you come from a 9 to 5 or whatever the case is. So I'm gonna add this little section in here, which is trade like a casino. There is a reason why casinos don't lose money and the house always wins. It's very simple. They only risk $1 to get a minimum of $2 back. That is where I get my risk to reward, and then all banks and institutions get this minimum of 1 to 2 risk to reward return from whatever is up at risk. So this is literally as simple as it is. Don't expect it to be 100,000 numbers on the screen. This is as simple as it is. You have 4 winners. 4 winners times your minimum of 1 to 2 risk to reward equals 8% win. And then let's say you have 6 losers, that 6 losers times we're risking 1% equals minus 6%. Obviously here you could tell that you're profitable. But the thing is that there is a random outcome, random sequence when it comes to these winners and losers. What do I mean by that? Because you can have the 4 winners come first, and then you're like, holy shit, I'm up 8%, I need to up my risk. But then what happens after that? Then you enter your 6 losing trades. So then that's where your P&L completely goes to shit, because now you have upped your percentage based off of your previous history, and then your emotions are all over the place because you feel like a Jesus, because you have won 4 trades in a row, and now you're ready for your 5th winner because you don't feel like 8% is enough. Or you can probably enter your 6 losing trades first, and then now you're down 6%, and then you're almost doubting yourself and everything that, doubting everything you've done your whole life. You're like, wow, I'm down 6%. And then you're now not motivated to get on the charts or to keep trading your own trading strategy. Now you change it up to then enter your winning streak. So maybe you were about to enter your winning streak after your 6 losses, but now you're either unmotivated or you're not, or now you're looking for a different strategy or whatever the case is. So you need to stick to your plan in order to have these results. And you must remain unbothered by the outcome. If you're winning, cool, that's why you took the trade. If you lose, cool. That's why you risk a certain percentage of the account. So now we're going to talk about gambler's mindset. And this is all something that you've had, I have had, we have all gone through the same exact mindset at given points in times, because it's just natural within the human being. What do I mean by that? It's because we all have this mindset, oh, because that hasn't happened within the past 3-4 tries, that means it has to happen next, double up, triple up. It has to happen because it hasn't happened the past 3-4 times. Because it almost feels like something is overdue and it needs to go down, and you don't want to miss it. When it goes down, you have to double up for the losses you've had in the past. For example, let's say you flipped a coin 3 times and every single time it has landed on head. We're like, it's the 4th time, it has to land on tails. Double up, bet all the money because it has to land on tails. And this is a false belief which leads to wishful thinking. And it gives you hope because now you have doubled up on something that hasn't happened in a while. So now you hope that it's going to go in your favor. And again, hope isn't a confluence. And then I'm sure you can already see how this turns into a downward spiral of emotions and of everything hitting the fan. Another very, very common gambler's mindset is, oh, that is way too high. It has to go down. I'm going to sell. Or that is way too low. It cannot keep going down. I'm going to buy. Well, that is so false. I have been caught in that. We have all been caught in this because it's just something that it's way too high. It can't keep going up. It's almost like swimming against the current. Why would you do that? Just simply go with the current. If something is going up, clearly you want to jump with it going up. If it's going down, well, then you enter the sells within the market. Why would you want to be the person to pick that bottom or pick that top? Why would you go against the wave or the current? And we come with this misconception because we're used to like regular business deals or regular stuff that the society knows, which is you buy a house at a low price and then you sell it at a high price. Well, this is not how this works. Charts can be in a downtrend for years, 5, 10, 15 years, and then you're now stuck in this whole downward movement. Or a thing could be in a bull market for 10, 15 years, same way how US 30 is, crypto, or whatever the case is. So why would you go against that? You simply go with it. So this is a perfect example why you do not want to be that person to say that they could pick tops or pick bottoms or whatever the case is. So here you can tell here GBP USD, I'm going way back into the chart when it had opened up. And then this was the point that price has seen the highest ever in history, right? So let's say it broke out of that level. We're like, oh no, I need to sell because it's way too high. It can't be going above that. Well, clearly you are wrong. You are seeing how it is using that level then as support, resistance, and then heading to the upside. And you can literally see just the simplicity in structure continuing going up. So you have literally just gone against this whole bullish sequence, clearly creating higher lows and higher highs, clearly above the EMA and creating beautiful bullish structure simply because you think it is too overbought. Same example when it comes here to sell. So this is the lowest point. I'm pretty sure a lot of you guys can remember this because of Corona, but this is the lowest point GBP has ever seen in the history of its trading. And obviously it is the round psychological level of 120,000. And then people swore that it is impossible for it to break under that simply because it cannot go any lower. Well, clearly the masses were wrong. As you can tell, COVID not only drove price back to that level, but it broke that level. So if you would have been buying at this level, you would have had a margin call or whatever the case is, because price could definitely keep going lower. Literally historic lows were created within the pandemic. That's why it is such a big deal. And it shows that price can continue to go lower or continue to go higher simply because you believe it is too oversold or too overbought. That is not the truth. The main indication to tell that something is going to reverse is not because it's too low or you think it's way too low. It's because of price action. So clearly you can tell here we went to that same exact support level, and you can see how it is 1, 2, 3 triple bottom, perfect rejection from this level. So this is an indication that it is rejecting and it could potentially have a bullish move from here. Not because you think it's way too low. And then you can very much see the simplicity of how it broke out, retested the broken structure, and then it kept literally just going with the trend. High, low, resistance acting as support, and just so on. It's just simplicity of going with the trend. You do not want to go against it. So this is something very, very simple. This is one of the main things and one of the easiest things to get over is just accept that it could keep going higher and accept that it could keep going lower. So if you guys want to see any more of these technical analysis, and if you guys like the whole course itself, I appreciate you guys making it all the way to the end. Leave a review. Let me know the DM. Whatever the case is. If you guys want to see the swing trading course, if you guys want me to do it, let me know. And anything that I do, I put lots and lots of overthinking and of work behind everything that I do. I literally wait to do it till it's perfect. There's no need to rush a product that's going to be out there basically forever, as long as people want to have it, and they can go back and rewatch it as many times. So if you guys want to see that, let me know. I would be something different, and it would definitely benefit a lot of you guys, because I do see a lot of people struggling when it comes to trading out there. They have so many things on their charts, and it's just less is more when it comes to this business. So again, thank you guys for watching the full course. Let me know what you guys think, and I'll see you guys throughout your guys' journey. So take it easy.